I'm actually going to do this webinar on basics of investing. A short introduction of myself. My name is Emin. CFA stands for Chartered Financial Analyst. It's an investment professional designation. What I want you to focus here is I'm actually a trainer, or I specialize in this area called fundamental analysis. Okay, fundamental analysis. Now, there's a lot of beginners here. If there's only one thing you can learn from this webinar, hopefully this is the message. Listen carefully. So stock market is the place that reward educated investor. So of course, is a standard disclaimer. So today I'm actually not giving you stock tips, stock recommendation. I'm doing purely education. Okay, so these are the key learning outcomes today. Like I said, there's no way today I'm going to make you an expert in investing. So really, the main purpose of today is after that, you should be able to know where to go and find out more information from. Okay, I'm just going to point you directions as to, okay, if let's say you want to find out this, where you go into. Okay, so I want to cover three big things. It's really basic knowledge of the different type of instruments. When we say stock, what exactly is stock? What's the bonds? What's the ETF? What's the REIT? So understand what you are investing. Very important point. Of course, a lot of times, there's no such thing as the best investment instrument, only most suitable. Okay, as in all things in life, okay, there is actually nothing, not about the best, but most suitable. Okay, so you need to understand yourself, what actually you want. Then after you see whether these instruments are they suitable for you or not. So we actually talk about that. And like I said, the most important here is this: how do I actually get you started on your investing journey? So in fact, this is the main thing I want to cover for today's session. So after this, where can you go to find out more? Okay, so let's talk about all the stocks, bonds, and different asset class. So when you actually buy into a stock, okay, like I said just now, what are you buying? In fact, you're actually buying a company. So buying a stock is no different from, let's say, three of us come together and form a restaurant, do a restaurant. Okay, so let's say three of us come together, we may need to form a company, we need to put in like $100,000 each, form a company. Then each of us will own about 30% of the company, and basically, we are actually holding shares of the company. So the share of our restaurant is actually no different from the share you actually buy from a stock market. Of course, in the stock market, we are talking about a lot larger company and you share with a lot more people. Okay, but very important. So know what you're buying. You're buying stock. You're not buying a number that moves. You're not buying a ticker. You're buying actually a part ownership of an underlying business. Okay, you're an owner of the business. That's why I always tell people, when people ask me what I do, I say I'm proud owner of 30 companies, of which I own companies like DBS, UOB, Singtel. Every time I actually walk in the UOB, I'll tell them, hey, do you know that I am one of the owner? Don't believe, go and check. Okay, I own about 0.0001%. Okay, so if you want to be an owner, you can. So in fact, if you want to own SGX, you can. So let's say tomorrow you go and buy SGX stocks, you can say, okay, I'm actually one of the owner. But of course, you realize that a lot of people are owner as well. Okay, so I know I put it very jokingly, but very important to have that visual. Know what is the underlying you are buying for any investment. Very, very important. In buying stocks, you're buying ownership of the business. So what are you buying for? Okay, of course, you buy for the dividends when the company make money. Okay, they will share the profits with all their shareholders in the form of dividends. And of course, when the company keep growing and get bigger and bigger, then your share will worth more and more. And when you sell in the future, then of course you're going to make money. Okay, so very important point. Now, please take note, you are a shareholder, you are the last to get paid in event of bankruptcy or liquidation. Okay, so like I said, go back to a restaurant example. Okay, so let's say, for example, we really put money together and form this restaurant. Okay, how much we earn, we share. Of course, if the company go bankrupt, you also get nothing back. We are partners, you are partners. So let's be fair to how the world works. A lot of people buy share, make money, keep quiet, lose already, then must complain, must this one not good, that one not good. No, please. Okay, again, I know I put it very bluntly, but once accept the real hard fact, the earlier you can accept the real hard fact, then you will do the necessary thing to protect yourself. Okay, so be very clear. When you buy a share, you're not lending money to people. You are partner in the business. Okay, so that's why when the business do well, you gain more, but the business do well, you will lose your money. That's what share means. So some terms for you to take note of when we talk about larger companies, big companies, we call them blue chips or large caps. These are just some of the terms you may actually come across. Okay, so caps is the short form for market capitalization. Okay, so anyway, it means large companies. Also sometimes it's good to learn some terms after webinar, so that you go back, can see your friends, you know what's blue chip or not, you know what's large cap or not. So more atas, at least know more about investing. Smaller companies, we call them mid or small cap. Okay, now the other type of investment in bonds. Okay, so when you buy bonds, what exactly are you doing? You are actually lending money to the bond issuer. Okay, so when you buy a bond, you are lending money to the bond issuer. So very different now. When you buy a stock, you are a part owner. Okay, in this case, when you buy bond, you are lending money. Okay, so of course, when you lend money, right, then you have a fixed interest coupon. And after that, you get a return of principal upon a maturity date. Okay, so you can see here, it says here senior to stocks in capital structure. So it's very different. Of course, if let's say if the company go bankrupt, they have to pay the bond owner first. They have to pay all the debtor first. Okay, so that's why the bonds, if your bond owners company go bankrupt, you get paid first. Anything left over, then you will pay off the shareholders. So understand this, very important. In terms of bonds, you are no longer a partner. I just lend you money. You better return me. If you cannot return me, I can sue you. Okay, you can't go bankrupt, I get paid first. Also see the difference between bondholder and shareholders. So of course, there are some standard terms, investment grade bonds, non-investment grade bonds, which is what I call junk bonds. Of course, higher risk bonds, but they give higher returns. Okay. Now, what are some of the fundamental difference between bonds? Maybe a numerical example will help you. So let's say a company borrow $100 for 5 years and start a new business venture and pay 5% as interest. So the company issue a 5-year bond for $100 and pay a 5% interest coupon on the bond. So that's what it means. So basically, borrow money is same as issue a 5-year bond, okay, and pay a 5% interest. So let's say in year 1, the company make $100. The cost is $80. Okay, because have to pay interest $5, $5 go to the bond. After pay $5, $15, this $15 go to the shareholders. Okay, as you can see, end of the day, shareholders share all the profit. So if let's say it's successful, company make more money, as you can see here, instead of making $100 revenue, they make $120. Okay, so you can see if you follow the mathematics, the net profit actually increased by 100%. Because the interest don't change. The interest promised $5, $5 don't change. Profit, revenue high, revenue also don't care. The profit don't change. Okay, but if let's say the failure, as you can see, same thing, instead of making $100, make $90. Interest also no change, but you can see that the profit dropped by 67.7%. So that's the difference between buying stocks and buying bonds. Buying stocks, you are a partner, you share the profit. Buying bonds, you're just lending money to the company. Okay. So there are other types of investment. So REITs, we'll talk about REITs later. Of course, you can buy commodities like gold, silver, oil. So of course, you can buy things like real estate. And now there's what we call private equity. So basically, you buy companies that are not listed in the stock exchange. So now today there's 101 investment. Okay, at this point, I just want to stress a bit more because I realize a lot of people misunderstand. Now, if you don't know about investment, understand this. Okay, investment means you put money in, put $1 in, hopefully you can get more money back. Okay, so when you get more money back, someone have to pay you the money, correct? The money don't drop from sky, the money don't grow from tree. Someone have to pay you the money. If you don't know where the money is going to come from, if you don't know why that person so good is going to pay money, then basically that investment is not for you. Okay, so do yourself a favor. Do yourself a favor. Okay, so in all investment, okay, let's face it, the world is not so nice. There are no people standing on the street down there waiting to give you money. Nobody actually does that. So when you actually invest, someone is actually paying money. You have to know where he get the money. You have to know why he give you the money. If you don't know, that investment is not for you. Very important. So of course, every year we actually see scams. Every year we see people, investing things that go wrong. But if you really talk to them, they don't even know what they buy. They don't even have understanding. Okay, so very important. Investment is not about, once you have the courage to get in return. No. So please understand, like I said, go back to the first thing. As I said, stock market is the place that reward educated investor. Okay, so a lot of investment, I'm not saying they're bad. Some are actually very good, but if you don't know what are they, then sorry, it's not for you. Okay. This is the historical returns on bonds and stocks. So basically, as you can see here, okay, if you actually invest in stocks, you will get higher return. If you invest in bonds, you get low return. But as in all things in life, it's very fair. High return always come with higher risk. Lower return, lower risk. So I give you from another perspective, it's probably easier to see. Now the blue line is, as you can see, Singapore government bonds. Okay. This is the performance. If you actually bought something at this point in time, okay, let's say if you actually bought the bonds at about this point in time, which is about $100, you'll become $188. Okay, but if you actually buy stocks at this point in time, you can see that you actually make 20% more. But of course, you can see that the stock market is actually more volatile, or the price actually go up and down more. So this is what we mean by risk, more volatile. Okay, if let's say you have to sell at this point in time, then too bad. Sorry, you're actually going to lose money. But if you can hold long term, you should be quite okay. So of course, end of the day, the good thing about investing here is this: you don't have to stick to one product. Like I always say, joke, like I said, I do jokes so that it's easier for member. I always say investment is to only find boyfriend, girlfriend, not married wife. Or wife or husband. So wife or husband can only have one. Boyfriend, girlfriend can have more. Okay. So you sometimes, if let's say you don't know whether stocks better, bonds better, then you can actually get what we call a balanced portfolio. Okay, have a balanced portfolio. Then of course, you have in between in terms of the return and the risk. Okay. Now, of course, then the question here is this: why bonds? Why bonds? Why stocks? So, like I said, end of the day, there's no such thing as which one is better, which one is the best. There's only this thing: which one is the most suitable for you. Okay, as you can see here. Okay, this is the x-axis is expected return, the y-axis is expected loss. Okay, of course, stocks is here, higher return but higher risk. Bonds is here, lower return is lower risk. So how do you decide what to choose? Okay, you can ask yourself, what's my investment goal? What's my investment horizon? What's my age? Ability to stomach temporary loss? Is there a need for regular income? Okay, so a lot of people don't believe what I said. So basically, for me, if I'm given a choice, I wouldn't want to invest. If today I have $10 million, for example, which I calculated should be enough for the rest of my life, I will not be investing. Investing is very risky. Investing is you take money out, put your money in somebody else's pocket. And hopefully that person will give you back and give you a bit more. Okay? It's risky. It's risky. So in fact, personally, if I don't have to take that risk, why would I do it? Okay. But if let's say like now I actually invest, one of the reasons is actually because I calculated, if I don't invest, I don't have enough money for retirement. Okay. Then I actually look between stocks and bonds. Unfortunately, bonds I cannot invest everything in bonds. Not enough. So I have to have a mix of between stocks and the less risky instruments. I don't use bonds, but I use REITs, less risky instruments. So I'm actually somewhere around here. Okay, probably somewhere around here. Okay, for my retirement. But once I hit my retirement goal, you can see I will slowly come more towards here. But when I was younger, I only have like $100, $200 to invest. So to me, if let's say I only get 5% coupon, you know, let's say $100, get 5%, I get $5 every year. Can't even bring my girlfriend to go and watch a movie. Also, of course, when I was younger, I was investing more in stocks. Hopefully my 100 become 200, 200 become 400 at the expense of risk. And I can take risks is because I was young, you know, money lose, never mind, I can always earn back. When I get older, I'm different. You know, in fact, now my salary don't drop. I'm already very happy already. Okay, so once again, what I'm trying to say here, the main point here is this: there's no such thing as best investment, only most suitable. And unfortunately, only you yourself know what is most suitable for you. So these are the questions you have to ask yourself. In fact, okay, this is no joke. I strongly urge, if you calculate, you think that, I got enough money, I will tell you, please don't invest. Okay, I'm serious. If you calculate, I have enough money already. What I want, what my money I have can reach it, then I'll tell you, don't invest. Yeah, I'm serious. Okay. So ask yourself this, then you choose the investing instrument accordingly. So of course, to invest in bonds, the most famous one, you know, is Singapore Saving Bonds issued by government. Of course, you can invest through SGX. There's some retail bonds. Also through SGX, there's bond ETFs. Then you can also, you know, buy through unit trust. So these are the few ways to invest in bonds.